All right, let's just jump right in. Imagine a massive structural shift in employee health benefits, one that literally just skyrocketed by a staggering 53% in a single year. We're talking over 20,000 US businesses getting on board. So, what exactly is driving this?
Welcome to The Explainer. Today, we're decoding the ICHRA paradigm shift. We've got fresh, hot-off-the-presses 2026 data, and we're going to use it to break down exactly what this defined contribution era means for the future of benefits. It's a total game changer.
Here's our roadmap for today. We're going to cover the rise of ICHRA, how the model actually works, and the shift toward employees as active buyers. Then we'll look at the massive broker advisory opportunity and wrap up with state policy and future growth. A clear, straightforward path through the B2B compliance jargon. Let's do it.
Part 1. The Rise of ICHRA. Let's talk about the new segment driving this momentum.
Now, historically, it was the small businesses that really pioneered this, but actually, scratch that. Right now, the momentum is completely shifting. The fastest growing segment taking over is applicable large employers. That means organizations with 50 or more full-time equivalent workers. Their adoption rate literally more than doubled year over year in 2026 alone. Why? Well, as traditional group health costs just keep climbing with those brutal, unpredictable renewals, these larger complex organizations are aggressively pivoting. They want to rein in long-term expenses and actually get some control back over their budgets. To put the sheer scale of this into perspective, think about the number 500,000. The HRA Council estimates that ICHRA-covered lives blew right past 500,000 at the start of 2026. And here is the crazy part. That number is based on anonymized data from just 17 member organizations. So it doesn't even come close to capturing the full market. If just 17 organizations equal 500,000 lives, man, the true number out there is likely much, much higher. It's quietly reshaping the entire national healthcare footprint.
Moving on to Section 2, how the ICHRA model actually works.
So to understand why this fundamentally alters the employer-employee transaction, let's quickly look at the definition. ICHRA stands for Individual Coverage Health Reimbursement Arrangement. Basically, employers set a fixed monthly contribution. That's it. Employees then take that exact chunk of money and use it to buy their own portable individual coverage on the ACA marketplace or another exchange. For employers, this is huge. Costs become perfectly predictable. No more waking up to a surprise 15% rate hike at renewal, and for employees, the coverage is totally portable. It travels with them throughout their career rather than being changed to one specific company plan.
Think of healthcare like going out to eat. Under the traditional group plan, the old era, the employer is like a strict caterer. They pick a very rigid set menu, deciding exactly which carrier and network everyone gets, and the employee just passively accepts whatever gets served. But under ICHRA, it's like being handed a dining allowance. The employer just gives a fixed budget, and the employee gets to look at this massive menu and pick exactly the plan that suits their specific family needs, their preferred doctors, and their risk tolerance. It's a fully customized, defined contribution approach.
All right, Section 3, employees as active healthcare buyers. When you flip the transaction model on its head like this, the ripple effect on employee behavior is massive. You're transforming workers from passive recipients into highly active consumers. The demographics are fascinating. Over 50% of these enrollments are coming from workers under the age of 45. Younger workers are all over this. They are out there actively navigating dozens of plans across multiple metal tiers in a totally unfamiliar marketplace. They aren't just taking whatever HR hands them anymore. They're shopping and they're making distinct trade-offs. So how exactly are they spending that fixed allowance? Well, most are strategically picking silver or gold tier plans to balance their monthly cost with out-of-pocket exposure. But here's an interesting tidbit. Some employees are actually throwing in $100 or more a month of their own money on top of the employer's allowance, just to secure much richer coverage. On the flip side, others are picking the absolute cheapest premium plans possible. Why? So they can intentionally keep the leftover surplus for other approved medical expenses, like dental work or vision care. But all this granular choice, it creates a huge navigation problem that the old passive group workflow never had to deal with. Suddenly, employees really need education, decision support, and serious enrollment guidance.
Which brings us to Section 4, the broker advisory opportunity.
This paradigm shift absolutely raises the stakes for benefits brokers. There's a very real displacement risk here, but also a massive opportunity for vital advisory work. Consider this stark warning straight from our source material. Brokers whose relationship with a large employer client is primarily built around annual group renewal are at greater displacement risk. And it makes sense, right?
Hybrid vendor-broker platforms are aggressively marketing directly to employers now. They're offering plan comparison, employee navigation, carrier access, and admin, all bundled into one slick software. If a traditional broker doesn't lock in a deep consultative role before the employer starts eyeing an ICHRA transition, well, they could get cut out of the relationship completely overnight.
Surviving this market requires a total reset for modern brokers. The traditional role used to be super transactional, scrambling during annual renewals, quoting massive spreadsheets of group plans, managing those passive enrollment meetings. But the ICHRA model, it demands complex, year-round navigational expertise. The engagement has to move way upstream to pre-transition strategy, consulting on financial modeling months before a decision is even made. The core focus completely shifts to complex affordability calculations and rigorous ACA reporting. And employee support goes from simply handing out a glossy benefits booklet to actively guiding individuals through the marketplace. It is an entirely different, highly specialized skill set.
Because of this, brokers absolutely must guide their large employer clients through some seriously strict ACA guardrails. For instance, Step 1. An employer has to base the legal affordability of their ICHRA on the lowest cost silver plan in that specific employee's rating area, not the plan the employee actually picks, which makes the math super tricky. Step 2. They've got to clearly define employee classes, like salaried versus hourly, way in advance. And Step 3. No overlapping choice. You absolutely cannot offer an ICHRA and a traditional group plan to the exact same class of employees. Getting these technical design choices wrong, it exposes the employer to severe ACA penalties and major discrimination concerns. High stakes for sure.
Finally, Section 5. State policy and future growth.
Let's zoom out to the macro environment for a second, because there's a very distinctly different story playing out for small businesses compared to large ones. Get this, over 66%, that's more than 2/3, of small businesses adopting an ICHRA previously offered exactly zero health coverage to their workers. Zero. So for them, this isn't about replacing a legacy plan to cut costs. It's a critical first-time access point to offer benefits in a really tight labor market. And what's wild is that this adoption grew rapidly in 2026, even facing the headwind of individual coverage getting more expensive after those enhanced advance premium tax credits expired.
And this momentum, it is being radically accelerated at the legislative level all across the country. We are seeing major, bipartisan state policy momentum treating ICHRs as a structural tool for coverage access. Back in May 2026, the National Conference of Insurance Legislators approved model legislation giving states a framework for small business tax credits. Today, Indiana and Mississippi have already enacted versions of it. And right now, similar bills are moving forward in Ohio, Connecticut, and Arizona. Lawmakers across party lines are neutrally clearing the runway here. This signals a massive pipeline of employers weighing this transition for 2027 and well beyond.
Which brings us to our final thought. The traditional one-size-fits-all group health plan is facing massive competition from this flexible, defined contribution approach. It puts the power of choice right in the employee's hands, all while locking in predictable costs for the employer. The momentum in the data is just undeniable. So the question you have to ask yourself leaving this explainer today is this. Is your organization truly ready for the defined contribution era of healthcare? It might just be time to rethink your strategy. Thanks for joining me on this explainer, and keep learning.